Alex Coffey, co-host of Next Gen Investing, is with me to go through these opening bell numbers. Good morning, Alex.
Good morning, Nicole. Yeah, pretty ugly start to the final trading day of the week, first trading day of August, but I think it's fitting that we close the book on July, in many ways maybe close the book on the slow summer trade. As back to school is just around the corner. We had a NFL football game last night. It feels like we're approaching the fall rapidly. And the fall brings different style of trade. It tends to be a little bit more active, and it tends to be a little bit more volatile.
Okay, so look, I mean, we know that those couple of weeks in July are traditionally the best 2 weeks of the year. August tends to be a month of a pullback. Historically. And you just heard Barry Knapp saying that the Fed has really missed the erosion of the economy, I'm paraphrasing, that could be happening here, and they should have cut, and that they should cut 50 basis points in September in order to catch up. So I guess some volatility may be expected here.
Yeah, I think that that argument resonates. I think if you were to ask Jerome Powell with some truth serum and Waller with some truth serum who feels more comfortable today, I think the answer would be Waller, given the dissent and the lean towards bringing rates lower. But I've long said, I mean, if you look at the Treasury curve, the one piece that's out of line is the Fed funds rate. The rest of it looks relatively, flat, but at least normally shaped. The Fed funds rate is the one piece that is quite significantly higher than, let's say 2-year yields, for example. But if we look at the big picture of the S&P 500, how quickly the picture can change. And now this isn't to say that, everything's falling apart and to run for the hills, but things look very, very, comfortable and in position for continuance of more of the same. When you look at this is the shorter term 10-day look. We can start there if we want. This is the last 2 weeks of trade, Nicole, and you can see just in the last basically 5 hours of open market trade, we have unraveled all of it. So first order of business, I think, for market bulls would be to break back into the range. And so that low end of the range that corresponds to the lows of the last couple weeks of trade is 62.90 when you look at the 62.90 on that. So when you look there, we're going to need a little bit of a rally to get to that level. That's the green line. If it's able to reclaim that back into the range, things can look a little bit better. But on the longer term look, things soured quickly below the 1-month moving average. Momentum indicators turning swiftly towards the more neutral and out of those overbought levels. But to me, the thing that's perhaps most concerning is just how quickly and on such a light volume we kind of charted these highs going back to the later parts of June. Really from about 60.50 to the 6,400 and some change that we peaked out, really didn't face much resistance at all. So as quickly as we gained those levels, we could quickly unravel them to the downside here. So you could reasonably make a case for just a healthy pullback still having at least 4 or 5% more to the downside before you get to some real meaningful support.
Yeah, understood. I mean, look, if you sell in May and go away, you still missed a rally. It's not like we erased the entire summer, but you make a great point. What a day and turning point this really is when you see bond yields at 4.24. Right? You have to rub your eyes twice because it's just not where we have been. So the treasuries are really telling us a story here.
Yeah, they really are, and it's escalating as the day goes on. It was kind of a slow reaction, particularly on the long end of the curve, to those jobs report numbers. But Nicole, it's hard to run away from them. I mean, the revisions for 2 months, almost 260,000. The 3-month average non-farm payroll gain is now only 35,000 over the last 3 months. And so it's the proper response for the bond market to start screaming a little bit of economic concern, and that's what we're seeing today.
That's and I'm glad you said that. The 35,000 over 3 months really tells the story. I mean, it's really stagnant. And to Barry's point, he actually talked to the private sector. He said, they worried that it would go down to zero. It was worse than zero. What's going on, right? The government spending has come down. He made that point. He thought that the Fed should have been cutting sooner and missed the ball. Ball, really. The policy was an error. Alex Coffey, it's good to see you. Thank you so much.